So, hi guys, welcome back. Welcome back to another lecture. Really good to have you guys here. I hope you're enjoying the lectures so far. For those of you who are new, welcome aboard. I was going to say, first and foremost, if you haven't seen the other lectures, please go back and start from lesson 1. It makes total sense. These lectures are a little bit further down the line, a little bit advanced. We're talking about stuff that we've probably explained fully in previous lectures, and essentially you might find yourself a little bit lost. However, if you want to start from this lecture so you can get an idea of how I bring market profile to the public arena, then you can do that. That's absolutely not a problem. But just bear in mind, you might be a little bit lost. So if you have questions that you feel are not being answered at this lecture, can you just go back to lesson 1? This is a complete market profile trading course series that I'm doing for 2025, and I've started from lesson 1. Again, for those of you who need access to market profile, probably don't have it on your platforms, I have it available. Discord link in the description below. Just hit the Discord, DM me. No problem at all. Market profile for me is a must-have as a trader. If you're not looking at this, you don't have it, I think you're doing yourself a disservice, and that's just my honest opinion. There is just so much you can see from it that you can't see with a basic candlestick chart. I've discussed this in previous lectures. I've showed you all the information that you're missing when you don't use market profile. Not only that, you've got the ability to segment your charts, and that is gold dust. It's why this thing costs money. Almost no one will give you that for free, but that's the thing. It costs money for that exact reason. So my personal opinion, don't have market profile, you're obviously doing yourself a disservice. But anyway, I'm not going to labor the point. Today, I'm going to talk about quite a few different things. One, I'm going to talk about shorter term profiles. That's what I'm looking for. I'll talk about shorter term profiles. I'm also going to talk about how we go do that top down look again, because I know we covered this in previous lectures, but it's a good time to have a refresh by looking at actual assets. Right, so moving on. Of course, I'm going to probably throw in a couple of more things. So let me initially get this ask line off the chart. And then we go from there. Inflation report out today, so markets are going crazy. But as I always say to everybody, is that if you don't have a position coming into a news event, you don't need to have a position. Market could go totally crazy. Anything can happen. So you don't necessarily want to be in a position that you're not really factored in terms of where this thing's going. Anyway, in a nutshell, moving on. So I'm going to start with that top down look. So I'm going to start with cable. So we all spoke about this before, right? And one of the important things I always say is that start with a weekly profile. So if we put this down into a week, let's condense that. So we're going to change the row size. You can start working with 10, 5. We're going to start with 10. And the balance, we're going to increase that to 5 to encompass the week. Just go OK. And then so we've got a weekly profile. For those of you who followed the previous lectures, first and foremost, you will see we had a weekly high, right? So that's the first part of our trifecta that we're always looking out for, is the high of the week. So if we put in a line just to denote the high of the week, and I know we've done this before. And if you go to the Discord server, you will see that I make posts about these trades a lot of the time before they happen, right? So it helps keep the community with a very zoned in perspective. So again, I'm primarily a cable trader, so you find I make a lot of posts about cable. Of course, I cover other assets like gold, for example, but I primarily make a lot of posts about cable. So you can see here that I've marked out what I would normally describe as my first trifecta, which is liquidity. So first and foremost, I want to see a run on stop losses, right? Or what I like to describe as hidden market orders, right? Because stops essentially, I've explained this before in previous lectures, stops essentially are not limit orders, so they're not visible. Essentially, it's information that you've given to your counterparty, that's your broker or some kind of liquidity provider. They have that information and they can sell it to other people. So a large entity wants to get access to a large amount of short positions or a large amount of sell orders. They want to deploy that. They will essentially go for buy stops. So they will try and find out where these hidden market orders are going to come alive, and that's where they're going to get their liquidity from. So that is why we describe it as liquidity. So if that's the case, then ultimately I'm looking out for that. So we'll initially push up, we'll do a run on liquidity, and then we'll pull back in, and then eventually we'll go to a bid stack, offer stack, which is another form of liquidity, but that's more reliable. So that tends to be where limit orders have been in the past, right? So essentially orders that have developed volume, right, which is part of my second trifecta, which is volume, and you will be able to say that here, right? So this is a place where the market had developed volume, right? We can tell from the bid stack that we see developed here, and then the market pushed and broke upwards. So this is the best reference point of relevant volume, right? So it says that there will be a degree of liquidity there, but it's going to be based on reliable volume as opposed to something not reliable, which essentially is market orders that come in at a specific given point in time. So we can only deduce where these kind of orders will be. So for example, if I was thinking that there's stop losses in specific areas, then I'll have to build a logic around it. So for example, I'll imagine that there's stop losses at higher prices, so above higher day, above high of week, above high of month, below intraday levels, so session levels, for example. These areas are going to naturally have a lot of orders to exit positions or even potentially to enter positions, but these are all going to be deployed as market orders because they're not visible to anyone, right? And this is the point I'm trying to make. So if you're a trader, you're another trader, you can't see these orders because they're not alive yet. The only person who has them is the broker or the other liquidity counterparty. If you're trading on an exchange, for example, it'll be whoever you've given the order to execute on your behalf, which again tends to be some kind of exchange-based broker. So this is important to know, right? So the volume part of the trifecta, second trifecta, volume, is here. So if anything occurs, I'm expecting that once we draw on the hidden liquidity, we're going to push in to the passive but active liquidity that we can see, right? Yeah, I should use a different word as opposed to passive and active in the same statement, I know, but I'm basically trying to say that we're going to come back to an area where we've seen volume before, and there's likely going to be passive limit orders there, which are going to be visible to everyone, right? So again, because limit orders are visible to everyone, it means they can be changed, right? So I can decide at a given point that I don't want that limit order anymore. So I can put a buy limit in and remove it, and put a sell limit later and remove it, and put another buy limit and remove it. So the limit order is always changing. So again, we need to develop a degree of reliability, and often we can't do that if we don't have a volume reference point, right? So that's where we know passive orders that are more reliable are going to come and rest at a later stage, and that's our limit orders. So when I get breaks like this, right, and then we break lower, I then start to anticipate and move towards a relevant bid stack. Now, through the course of this profile development, right, so these are weekly profiles, we've seen that. Now, a good way to visualize that is to split the rotations. So we can see initially when we drew on those stops within a given week, we started to develop that shorter term appetite for the downside. So that gives us an opportunity to pick a position, for example, in a 4-hour time frame. Again, this is a shorter term window to the week, but the rotations are 4-hourly. That allows us to get in and short, for example, on a shorter time frame. So this is how we do that one window top down analysis. I've got a weekly profile I can execute on a 4-hourly time frame. So I can do it all within one window. The issue most traders have is that if you're using a candlestick chart, one, you're going to have to build a weekly chart, then you're going to have to build a daily chart, and then you're going to have to build a 4-hourly chart, top-down analysis. We've all heard that term. With a profile, you don't need to do that. You can see the profile over the week, the statistical benchmarks associated with that, and you can also see the rotations, which are the letters, which essentially are the auction periods, which you can customize to suit you. Now for me, that's gold dust. I don't know about you, because it allows you to visualize a lot of information right there and then at a glance and make a decision, right, without a lot of anxiety. So again, you can see, and I've called this trade already, it's available in the Discord, so if you have any questions, any doubts whatsoever, just head to the Discord. Nothing to discuss. We did the stops and we started a pullback, and I said as soon as we start to close within the trading range of this neutral profile here, then we should essentially start to auction lower, at least to the D period low. So at this point, we're at the early point in the week. So again, one of the things, the third trifecta is time, right? So an early point in the week, and we want to be taking those trades at major center opens. And I was going to show you that as we go to the next level of segmentation. So for now, we can see that a weekly profile is just opening. Typically in cable over the week, we look at ranges of about 200 pips. For now, the range is only 87. So there's at least 100 and something more pips that we can do here. On big outlier days, we're easily doing 400 pips in a week, 239, 175, 164, 178, 282. So we have a benchmark idea. The average we're expecting in a week is somewhere between 200 and 250 pips, right? We've already done 87. That's already telling you this market still has some movement to do. What's going on right now? We've got an inflation report coming in. So it's a news event. It's likely going to add some volume into the market and definitely a degree of volatility. So if you already know the direction, which we've spoken about or anticipating at least a run into 133 for the pound, then we can start to deduce that point in case if this kind of volatility continues, then we're going to be at 133 this week for sure. Right, and it will be in line with the fact that we've already run and we've taken the liquidity at the highs. Now, the other thing we pointed out is that as we continue to do new highs, because some of you would be asking, say, well, what about this big move here? How did I know that we're drawing on stops at this point and this market wasn't going up? Okay, so if we split this profile here, we can see that this week we took the liquidity at a weekly high from the prior week, and then we backed lower. Right, so if we split this, we can see this huge 4-hour flush in P period, right? And then essentially the market recovered to the top half of the P period. And we've spoken about this before in previous lectures, but again, I have a professional trader program series on this YouTube channel, and I'll link to it in a card at the top of the channels. So essentially you can access that. I think it will be a few minutes into the video, so if you need to click on that at any point and save that particular series, you can go to it, where I do talk about volume, how you use that in a candlestick chart, for example, right? Because I know, of course, not a lot of you have market profile or can even afford to have market profile. Again, if you do want it, I have it at a basement bargain price, right? Most people will charge you a monthly subscription for it. If they're not charging you a monthly, which is, I'm talking minimum £40, or if you're in the US, I think it's something like $50 a month minimum, or even if you've got something like TradingView, where you might be able to get TPO chart on TradingView, it's still going to cost you a monthly subscription. People are not messing around when it comes to this, so you're going to pay money. But I've decided to give everyone a lifetime license at a fixed price, which is stupidly cheap. Sometimes I think to myself, am I absolutely losing it? This thing costs me a lot of money to make. I produced this myself. I spent my own money to build it for MetaTrader 4 at the time, because I've had it for a few years. Unfortunately, I haven't been able to get it on MetaTrader 5, but it doesn't matter. Most brokers, I think it's like 99.9% of brokers support MetaTrader 4 and they have it. And despite what you may hear, it's still a really good platform. full stop. In fact, you're looking at a MetaTrader 4 platform right now on a demo with a specific broker. I don't mention names of brokers on this channel, but I have it with a specific broker. You can get it with any broker, right? As long as they don't block API. And I say this repeatedly, there are quite a few of the big brokers who absolutely have no issues with you having a tool like this on your platform. You can do it on demo, you can do it on live, it doesn't matter. If you have an execution on a MetaTrader 5 or something, or you've got another platform you prefer to use, like for example, I use CTrader a lot. Again, you'd see that in the Discord server. Again, if you have your preferred platform, doesn't mean you can't use it. As you can see, I'm using it. Otherwise, I wouldn't be doing this video. So sometimes people leave in the comments, do you have this for MT5? I have no idea why you're asking me that question, because it really does not matter. You've got one of the best tools in the business. The price quotes on MT4 and MT5 are exactly the same. I trade almost every single day, and I see this without a problem. Point in case, right? The only difference you might see is that if you've got a live account with one broker and a demo account with another, there might be some price discrepancies. But the overall direction of where things are going, tick for tick, is exactly the same. In fact, most brokers have almost an aligned price quote within 1 pip of difference between each other. This is just facts, right? So I don't really expect people to feel like they can't have this because it's not on MetaTrader 5. That's just a ridiculous notion. The idea here is to make money, not to have MetaTrader 5. Yeah. So, but you know, that's just my personal opinion. Right, so again, you can see what I mean is we drew on the liquidity and then we start the breakdown. So if you were lacking confidence in this trade between O and P period, that would have been cemented. I know a lot of strong traders who would be short on O period against the wake and be looking to carry this all the way down to the D period low, which is ultimately where I believe we're going. So that's gold dust I've just given you there. I've given you my price prediction for cable. I can see there's a gap in value here. So for those of you guys who are watching this lecture and have seen the others, you're saying to me, hey, GT, what about the gap? Yeah, we could get volatility that gets us to fill the gap, but if we recall, gaps don't always fill straight away. This is a weekly profile, so this gap might go for anywhere between 6 to 8 weeks before it fills. So the gaps are not always immediate fills. We're talking here about sell pressure, and depending the gravity of that sell pressure, we might not go back to fill that gap. And also, for the more observant ones among us, we can see that there's a massive offer stack sitting here. And that is going to present some difficulty even if we were to go to fill the gap. So this becomes another great sell opportunity. If we were to get a rally and then we hit the volume, we're going to come back out again. And likely we're going to start to make at that point for the bid stack. I'm just of the opinion that we might do that sooner than later, but the overall direction is down. We will always come back and review this in future lectures. This particular scenario I'm walking you through, I'd already alerted the group that we're going to come back and look at this at a previous lecture. So everyone knows that this was taking place. So this is not new. So if you're watching this for the first time, I'm not pulling this out of my ass, right? This is something that we'd already looked at and we were already sure it was going to happen, right? So anything else now is just us going over it. Right, so again, this is for learning purposes, so I want to be able to break this down in a way that you will normally look at it from a trade perspective, right? And I'm working on the right side of the chart rather than the left side of the chart, because you know the left side of the chart has already happened and it's all pretty much, we can say anything at that point. But the right side of the chart is much harder because I'm looking at pretty much the past 3 weeks to now. How would we have traded it and how would we trade it right now? Again, we're down in the hole, so I wouldn't be looking for a speculative position because there's not a lot here. If I was going to short this, I'll start from here. That's my point. Secondly, I get enough of a move to here, I'll be in a cover. So if I shorted here, I'm exposing myself to additional risk that I don't need. If I'm an intraday trader, and this is going to be part of an intraday trade, the next part, this particular video, I'm going to show you how we work that. So we've done this analysis on a weekly profile. Ideally now, we should be able to swap to a daily profile to visualize the exact same thing. So I change this to a week, but I'm going to change this back to a daily profile. Again, our daily profile for cable would look a lot like this. So we're looking at 1 hour rotations, midnight start, and then I'm going to drop this to 4 for the row size, and then the balance to 1, because that's all I really need. Click OK. And as you can see, stretch out the scale so you get this nice and aligned. And as you can see that move down here. So again, you can see those points on the daily chart where we had those breaks. So I'm just going to extend this line out a little bit. Right, so this is the point in the week where we drew on liquidity and we had this big move down on a daily bar. So once again, if we put point in case, this is that offer stack on the week. You can see this all the graphics and the lines translating now into the daily. What happened on the daily? Let's go a few days back, right? So again, for those of you who wanted a more of an early move into this, you can see that we had stops being run on the daily and the weekly frame, right? So you can see that liquidity, first part of the trifecta, we pulled on the liquidity. So you can see the result of that. So we had some stacking. It looks like we're going to do a break. We hit the buy stops and then we came back out. Well, you will be forgiven for seeing the move here. Right, so if we split just these two profiles, let's split this one here. You can see very clearly the T period high, and then you can see us go up there and draw on that and hold at pre-market 12 noon, right? So that's part a time trifecta comes into play. We normally say we wait for positions in the NASDAQ, right? And that was 2 p.m. and then we continue to put in new lows against the NASDAQ. What do I always say if we're putting new lows against the NASDAQ? It means that if there's high volume in the NASDAQ, and I'm going to show you when we segment again, because we can segment further. If we're putting in high volume in the NASDAQ, which is Q period, then essentially that means that if we're doing new lows, that the sellers are in force. The only thing we're likely to say is if we were to trade above the NASDAQ at any point at these highs, we might look at a stop, an intraday or an intra-session run on stops, which is what we got on this particular NASDAQ move. So we put in new lows in Chicago, put in new lows at the FTSE close, and then we rallied overnight and then took the stops above the NASDAQ high and continued lower. So the advantage here would have been handed largely to the New York traders. So if you were trying to get short against the week, right, knowing this information, and you were getting short in the hole, which I don't recommend, and I've said this time and time again, if we've moved considerably away from the high, I wait for a rally to get into that trade. So again, let's say you wanted to get into the trade on a rally back into the NASDAQ level, right? So that would mean your short will be here and your stops would go above the liquidity high, right? So that will be somewhere above P period, or even, depending on how long you want to hold this for, the M period high, right? Now already you can see this wouldn't have been a bad position, right? From risk here to big drop and holding all the way. So the daily chart presented us with an opportunity to execute within the intraday. This is really super important. Right, so let's close this back up again. Right, so we can see there was a run on liquidity, and this was the confirmation on the day that this market was going to start moving lower against the week, because the daily bar closed under the weekly high. I hope this is making sense. Once that daily bar was under the weekly high, we had a big trend day, right, with some responsive buying at the low as expected. With trend days like this, you normally get a bit of a pickup because people are going to buy the low, get short-winded runs, just going to play the volatility. But the overall position essentially is down. Some of the nuances that we've discussed before, we were hitting value low against this bar. So this is all obviously pricing that is now way cheap relative. So there was going to be people trying to buy it. That's okay. As we moved into future days, you start to now look at levels, right? So again, some nuances. We got a single print within the value area. If you recall, we call this minus development, right? Minus development is a very strong resistance level. And again, that takes us back to the second trifecta, which is volume. And because it's volume within the value area, it's a single print because prices were so competitive there that whoever the seller was really put some weight into the market. And as a result, within the intraday period, we were not able to trade those prices again. It's easy to see when you lock the profile in, it takes away the illusion. But if I open it, all that was a move that essentially we created a low in end period, right? So that's the low of the end period session, which was 11 a.m. And this was a pre-market move, and we put in a close, and P period, we stopped short and put in a further low. And that created what we call minus development, or a gap within the high of the forward bar and the low of the previous bar. So it creates this somewhat indication that there was some strong contract flow, order flow, supply going on at this level. This is super important because minus development is not easy to observe, right? So if we close that, we can see that. So our expectation is if we pull into the midpoint of this bar, which is almost exactly the minus development, we're going to start to see selling pressure. Right, so that's a nuance, right? That's something that I would normally reserve for, my mentorship, my private clients, people who are looking to go professional on this. This is the nuances we'll look at. I wouldn't have normally looked at it here, but again, that's some nuggets. It's just some of the good stuff. It gives you an idea of what I like to bring to the table. So I'm going to take this away for now. All right, so we can see that was a good shorting opportunity on the daily frame. And this is something we discussed. Again, if I further segment, so I wanted to get you to see that point relative to the weekly profile. So if we go and have a look at where we are now, first and foremost, we can see two gaps on the daily profile, which essentially means that at some point we're going to attempt to close these gaps. So a rally is coming. We've also clearly pointed out that at some point we're going to run into an offer stack. Right? I've accidentally deleted one of the lines. They're not a big deal. At some point, we're going to trade back up and we're going to run into a degree of resistance. So we already know that, but we know that we can at least rally to this point. Right? We're seeing evidence of this because this market has been falling for a while, so I won't be surprised to see us pop back up. But for now, very difficult to deduce because we're coming into the NASDAQ open very shortly and we've just had an inflation report. So depending what the NASDAQ traders do, right, if they can hold the volume for the day, then we might see this thing rallying, or we might see this thing going lower, or essentially consolidating for the rest of the day. Either way, I think that we're going to get to this point where we're going to have a turn. And one of the things you can do with this profile is you can narrow it down, so you can make it a little bit smaller, so you can see where those downside levels are. So again, if we're looking at where the next stacks are, for example, so we've got a daily bid stack sitting here. So we can expect a turn at these kind of levels. I've been observing the weekly levels, but again, you can see that here. And you can also see that there will be some liquidity underneath the lows. So this is a perfect price level for the market to rally out of and at least attempt, in my opinion, to go and take out all these price levels that it needs to probably do. Right? We could do it before, we could do it after, but I essentially wouldn't look at a long position outside of an intraday unless we were trading back at these levels. Anything else wouldn't make sense to me. We do have somewhat of a bid stack here, but in my opinion, it's not enough to keep this market up. In fact, you can clearly see that we were really just filling this gap here, right? This was a missing gap, and I spoke about this gap on the Discord server, that this was a gap to fill. If you want to see that conversation, just go to the Discord server, link flashing right now in the description below. Right, so you can see that this is how we start to develop a thesis, right? So now let's say, so if you're a swing trader, what I've told you is just gold dust, and that's probably what you're going to spend a lot of your time looking at. If you're an intraday trader, it's a different ballgame. So now that we know some of the daily levels, right, we're going to segment further into the intraday. Now with a profile, you get a little bit less information doing a profile segment on an intraday, but it's still going to be pretty good. So we're going to do 1 hour profiles, 5-minute rotations, and then the row size we're going to bring to 1 and a balance to 1. Right, so essentially what we've done is we've created 5-minute rotations, and then we've also created 1 hour profiles. So we essentially, each profile is 1 hour, right? So here's where all that understanding of session time is really going to come into play. So first and foremost, we don't trade outside of periods that have liquidity for good reason, right? So we're looking at primarily the NASDAQ Open, the Chicago Open, the London Open. If you're trading cable, those 3 sessions are going to be super important. If you're trading anything else, you'll have to decide which one of these sessions is best. But if you're trading cable, that's the best session. Most of our assets are really going to work for you in the US Open. Again, this is super important to note because most of the time, most traders are not thinking about time as part of their way to get into positions. So let's take today, for example. Right, so you can clearly see that, so I'm going to break down this panel here so we can look at this particular bar. We can see this is 8 a.m. It's showing it's 10 a.m. It's actually 8 a.m. and that's because this broker's a 2-hour shift. It's 8 a.m. in London. So we can see this is the London Open, right? And that was that bar, which essentially denoted the London Open. So again, if we were coming into the London Open and we wanted to make a trade, we have to essentially historically see where the lows have been on prior sessions. So if you look very closely, you can see overnight we were putting in some lows, and then if you look at midnight, that was the start of the Asia session. And then you can see that we traded under the lows and then hit the stop losses intraday. So that was prior day low, and then we closed higher and then we consolidated. By 1 a.m. in the morning, London, we were already offering considerably away from where we'd seen the initial run on sell stops. Again, perfectly fine. It's given us the indication this market wants to break upwards. So if we were trying to make a trade, and we're looking at the London session as our option, there are a couple of nuances we can look at. So for example, and I'm going through this because we haven't spoken a lot about short-term segmentation and how we come at this. So all of these times, there's pretty much times we don't want to be putting trades on. We really needed the market open, which was the Asia Open, and typically 0100 hours when we get the futures and also major Asian sessions opening. So if we wanted to use this as a benchmark to get in the trade, then the trade should come somewhere between 0100 and 0200, right? From a time trifecta perspective. If we get to 3 o'clock or essentially 0100 in the morning, right? So 0300 with this broker, we want to be able to say, well, I think we're a little bit too late. If we're going to get into this position, we need to wait for essentially the London Open to kick off. What you would notice, of course, is the market was flat between these couple of hours, right? So what you can see is neutral profiles developing, and this, my friends, is volume. So we can see a neutral profile or build up of volume right here. And what do we see? At 6 a.m., we get a big close above that volume. So essentially, we're breaking out from the volume. But we don't want to get long here because there is a very short-term high that developed at the futures or 0100 open. So we want to kind of take that into consideration and say, well, if we're going to get long, we need to probably get long from the volume area with stops somewhere underneath the low of the Asia session. But we've got some structure here. We can see volume building, we can see very solid value lows, and we can also see fair price and value low here back into where we broke above. So realistically, if we're trying to get long in a London session or in a European session, then really we should be aiming for a retest of the volume area with stops just underneath the low. So you've got anywhere between 10 and 14 ticks worth of stop. This market ran for about 35 pips into the US session before collapsing. It ran for 27 pips in the European session as well. This is how you tackle an intraday. So we're still working with the same model. Liquidity, volume, time of execution. We don't want to execute outside of times where we're not going to guarantee a quick move. So again, coming into the next session, right? So again, you can see this was the inflation report. We'd already done a high by 11 a.m. in Europe. So this is the European high. Right, put a line against that. Now, what do you see developing as we were coming into the European high? We can see volume was intensifying, comparable to the London Open, which had the highest volume for the entire session. At this point, we can see quite clearly that there was a level of demand at the lows, but obviously we're now starting to see supply coming in, and that's evident by the tightening value areas and the build-up of volume. So at this point, if there was any doubt in your mind what's happening, it should start to vanish as soon as we traded over. So if you split this rotation, now let's say you're an intraday trader, you can clearly see, well, I'm going to make this a little bit bigger for this purpose, let's blow this up. So you can clearly see, so if we widen the scale, so we can see very clearly, you can see the G period closed off here, intense amount of volume no doubt, and then we start to break back in again. So if we wanted to get short, we can see the J period run. So it looks like we're taking stops. We get that confirmation once we start to pull back in again. However, this was a fast move. It was an inflation report on a 5-minute chart. So here you've seen we've hit a low, we're pulling back. How do we get into a trade like this? We have a few reference points. So value high, because we know that there's a 70% probability that if we enter a value area in one direction, we're going to go all the way through it. So there's a guarantee we can get a trade here. Secondly, we have the volume area from the previous bars, which is saying that if we went lower, there's a good chance we can come back and attack these prices. And this area will be a good place to have a short with stops above where we know the stop losses have been run. We shouldn't really revisit these prices again. So anywhere within here to here would be good. So that's a 9.5 pip run. And then we want to see if we can get a short position in off the back of that. I like to trade off the NASDAQ, but this is a news day, so it changes the dynamic. We're getting news at 1:30, inflation, and traders are going to trade off that. I like to wait for the NASDAQ because the response might be entirely different. But if you're a short-term intraday trader and you've seen a run and stops on the intraday, especially above the European highs, and we're closing solidly lower, and you're trying to get position in, then you're just looking for a retracement or a rally. So you can see the value area high is going to be a strong level, and the market really struggles to take value area highs, especially when they've been set by strong sessions. So we want to keep an eye on that, right? So if we're already in, what we're doing at this stage is, so let's zoom out a little bit, is we're looking for a revisit or push to the downside. And I'll tell you exactly why we're looking for this, and there's a specific reason. Let's move this, there we go. So if I move this line here, we're looking for a move into the Asia lows. And that's because if the US session is stronger, we should take out the Asian lows, right? The Asian traders are going to be weaker. So but that's what we're aiming for ultimately, is to get down here and crush out the Asia lows. And if we're going to rally off sell stops that are sitting underneath the Asian low. There's no other way to get back up. So one, I want to be in a direction of that flow. Secondly, if we go back and we think about what we said in the previous segmentation, starting from the week, we are bearish. We expect this market to go all the way down to the underneath of the 134 handle. Right? And if we look very closely, we will see that 134.14 is not even the 134 handle. Right? It's an intraday play. We're trading 5-minute rotations, 1-hour segments, right? So 1-hour profiles. We've got all the information we need. We're now expecting a push below the lows. So that's our game plan. However, the opportunity to take profit may well come before those lows, and that's what we have to move with all the time. We have to work with our trading plan. So if we were doing a 5-minute rotation and we've managed to secure a good price here with stops here, then we're looking to only get this down to 20 or 30 pips, depending, to essentially make a 3-to-1 or 2-to-1. In a US session, we should get the range, right? And that's the other part of this whole thing, is that typically on an intraday basis, if you recall, we should be able to get about anywhere from 60 pips to 100 pips on any given day, back and forth. If we look at how many pips we've done over the course of today, we've done about 51. So there's still some wiggle room here for us to go lower. So the US session should produce a lot more range than the Asian and the European session, and essentially that would mean that we're looking at anywhere from a double variation day profile to a trend day profile. Right? Double variation days are more common, or slightly extended neutral profiles. Today, if you look at this, what we're looking at currently is what looks like a neutral profile, right? So essentially a range day. Now, I'm not expecting that after an inflation report. I'm expecting that we start to build a little bit more momentum as we open the NASDAQ in about the next 15 minutes. So we're seeing a lot of slow action on the start of 2 p.m. because we're not yet at the NASDAQ open. Also, we can see on a much smaller frame, we're taking out what looks like sell stops within just underneath the inflation report 1 hour window. Right, so there's all kinds of things going on. We don't want to get caught up in that minutia. We just know where we believe the market's going to go based on the 1 hour segmentation that we've seen of the inflation report in the New York Open. If we're going in a short position with a view to take out the Asian low, that's what we're doing. Our stops are in place, so we don't really mind if this trade doesn't go our way. That's the next layer, which is risk management. Right, so I hope this particular run through has made a lot of sense. So again, this is how we segment. We start from a weekly, we go with the trifecta, liquidity, volume and time. We segment down to a daily, confirm whether that daily is lining up with that weekly, and then we segment down to the intraday where we can start to pick positions, and then we can segment further down into the 5 minute to get into that slight minutia that we need in order to kind of narrow that risk a little bit and get a more effective trade through the intraday. We're working a lot more with time in the intraday, so that time trifecta is really important. When are we executing? Are we waiting for NASDAQ? Preferentially, I always prefer to wait for the NASDAQ to open. That is my preference, and that's because the NASDAQ is a US stock market. It's major. It can overturn an opinion in a minute. There could be something coming out of the stock traders world that is going to send everything going crazy. We don't want to miss that opportunity, so we're always going to play to ensure that we can catch that opportunity. So it's NASDAQ, and usually if we're seeing weak volume in the NASDAQ, and I've spoken about this in prior sessions, I've spoken about this in my PTP professional trader program, weak volume in the NASDAQ is a problem, especially if it's weak relative to the European session or it's weak relative to the Asia session, because it just means that we're probably going to see a much more directional move in the Chicago Open. But if the NASDAQ and Chicago Open are both, for example, posting low volume, we've got a serious problem. If the Chicago volume is surpassing that of the NASDAQ, then we're looking at the NASDAQ levels going to be completely below that out of the water. In fact, there are a lot of stock traders even who prefer to trade at 10 o'clock as opposed to 9 a.m. Eastern, right? Or 9:30 a.m. Eastern when the stock market opens, the NASDAQ opens. Right, so point in case, guys. That's how we do it. It's not complicated. That's it. That's the game. And if you're consistent with this, you're going to make money. There's no other way, because now we're talking about probabilities. Can you get this right 50% of the time? If you can, you're killing it. Can you get this right 45% of the time at a 3-1? You're killing it. If you can you get this right 50% of the time at 2-1? You're killing it. Can you get this right 60% of the time at a 1-1? You're still killing it. Come on, guys. This is not difficult. It is not hard. This is a game of scale. Now we've got all kinds of ways to scale. Prop firms to scale, capital. We've got, we've got loans for God's sake. If you're so desperate for money, you can manage money for people if you know what you're doing, but you have to be disciplined. So I'm aware a lot of the game is about the psychological discipline. You got to work on that. I've got videos on my channel that cover all around tips to psychologically discipline yourself. If you needed that, those are different videos. You can have a look at those too. Awesome stuff, guys. I hope you enjoyed this particular lecture. I felt it was important to just do a top-down view to kind of rehash what we've been discussing in prior lectures and really get you building that skill set. In the next lecture, we're going to get a little bit more into assets as well, maybe look at some individual assets like different commodities and how we attack that. Because one of the things I haven't really spoken a lot about is the personality of different asset classes. Whilst most of them do the same thing, they've got slightly unique personalities. And often, how do we bring those out? How do we know what's best to trade? So we're probably going to try and talk about that in the next lecture. But for now, guys, adios.